Okay, so I'm going to go ahead and share my screen. Okay, so let's start at the beginning. Okay. So, can everyone see my screen? Perfect. So, good morning and welcome to our How to Downsize or Right Size Using a Reverse Mortgage seminar. I'm Marla Wong, and I am a member of the Wong Real Estate team. So our objective today is that we want to share with you some strategies to help you be in the best living situation that you would like to be in. And I have a little video I wanted to play for you. Great. So go to the next slide. So the benefits of downsizing are that it frees up funds so you can live the lifestyle that you want to live, and you can live where you want to live. You'll have no mortgage payments, and you can take your property tax basis with you. So I'm going to turn over the mic to our broker and team leader, Debbie Wong.
Hi, everybody. Thanks for being here today. We really appreciate it. And we've got some really great information for you. So this is our team. So meet the group here. Of course, you already met Marla, who is hosting today's session. We also have Nozomi Ojihara, who is a native Japanese speaker, and also Jermaine Revelo, also a realtor with us. And all of us together, we are real estate planners. And so what do real estate planners do? Well, what we do is we help you build, protect, and transfer your real estate wealth for generations. So whether you're just starting out, getting your first home, or buying your first investment property, or perhaps looking to retire and unload investment properties, whatever stage you're in, we're there to be of help.
So I'd like to introduce our guest speaker today, Hannah Edwards.
Hi there. Thanks for having me today. So I work with clear to close brokers, and as brokers, we have every product imaginable. I have been in the mortgage business since 1993 and have worked through every type of real estate cycle imaginable. And I did focus on investors for a while, but now I focus on reverse mortgages and bridge loans.
So let's get started on some information about reverse mortgages. Oh, before we start, I'm sorry, let me read our disclaimer. So the information provided in this seminar is for educational purposes only. While every effort has been made to ensure the accuracy and reliability of the content presented, we make no representations or warranties of any kind, express or implied, about the completeness, accuracy, reliability, suitability, or availability of the information, products, services, or related graphics contained in the seminar for any purpose. Any reliance you place on such information is strictly at your own risk. We disclaim any liability for any loss or damage, including without limitation, indirect or consequential loss or damage, or any loss or damage whatsoever arising from loss of data or profits, arising out of or in connection with the use of this seminar or information presented. The views and opinions expressed by speakers or presenters are their own and do not necessarily reflect the views of our organization. Reference to any specific commercial product, process, or service does not constitute or imply endorsement or recommendation by us. We recommend consulting professional advisors or experts before making any decisions or taking any actions based on the information provided in this seminar. So now Hannah will explain a little bit about reverse mortgages.
Thank you. So everyone's heard of a reverse mortgage, but there are a lot of misconceptions. It is a mortgage very similar to any other mortgage in that it is a lien against the home, a loan, a lien, but the borrower is still the owner and you retain ownership of the home. There are two main types of reverse mortgages. One is called HECM. This acronym stands for Home Equity Conversion Mortgage. That is the one that is insured by the FHA, the federal government, the Federal Housing Administration. It does have loan limits, so it doesn't always work for the Bay Area because the loan limit isn't high enough. And so then there's another type called a proprietary mortgage, and that one goes up to $4 million. And it has no FHA insurance or any type of insurance on it. So with the HECM, the youngest borrower has to be at least 62 years old. And with the proprietary, the youngest borrower can be younger. Here's the most important thing. That home has to be your primary residence, and that's defined as living there 6 months plus 1 day per year. If you're lucky enough to have several homes and you're not sure where your primary residence is, then look on your tax return. That's where it will show. So here's the greatest advantage and why people get a reverse mortgage. You never need to make a mortgage payment to the lender while you're living there as your primary residence. Never, ever. You still have to pay the property taxes, insurance, and if applicable, homeowners association dues, and of course, maintain the property, not let it go to waste, as they call it. The heirs will still inherit any equity after the loan is paid off. That's very important because people worry about that. Historically, in the Bay Area, the values have gone up so much that there was still equity for the heirs to inherit. But I do not have a crystal ball and I'm not making predictions. I'm just telling you what has happened historically in the Bay Area and in many parts of California. The borrower and their heirs are never, ever personally responsible for more than the value of the home. That means whatever the home can be sold for on the open market at the time that the loan is going to be paid off. They are never personally liable, nor is the borrower ever personally liable for anything more than what that home could be sold for on the open market when the loan is paid off. It is called a non-recourse loan. The collateral is the only thing the lender gets. Qualifying is much easier than a regular mortgage because you're not going to be making mortgage payments and the lender knows that. A large down payment is required if it's a purchase. So everyone wants to know how large. Well, it is specific to how old is the youngest borrower and what the prevailing interest rates are at the time. But just to give you an example, today, April 25th, 2024, I have a borrower who's 70 years old. She wants to buy a house for $700,000 because she's downsizing. She has to put down $450,000. If she was 10 years older, the down payment would be smaller. If the interest rates were lower, the down payment would be smaller. So it's very specific to each situation. And there is never, ever a prepayment penalty on these loans. So if you win the lottery, just pay the loan off, no penalty. Or let's say you don't want to build up defer the interest on the home, because of course, when you're not making a payment, they're adding that interest back to the loan balance. And if you don't want that to happen, you could always make an interest only payment. It's completely up to the borrower. Never a penalty to prepay. So let's give an example. So my friend Dale, he sold his home, paid off his big mortgage, and then ended up with $800,000 cash. Plus he had $90,000 in the bank already. So if you look at the blue column, he has a total of $890,000 after having sold his home through the Wong team. And then he wants to purchase something out of the area for $850,000. Because of Proposition 19, he can take his low tax base with him to another county, any county in California, and live near his kids. He puts down $600,000, and then he has no closing costs because that's all included in the mortgage of a reverse mortgage. But he does have $15,000 in moving expenses. So out of pocket, he's putting out $615,000. That leaves him, blue number highlighted below, with reserves of $275,000 to keep for the future. If he were to do this same transaction with cash on the right-hand side, cash only, he starts with his $890,000. He pays $850,000 for the house. He has $25,000 in moving and closing costs. He's now come out of pocket $875,000, and that leaves him with a paltry $15,000 in the bank. This is a great advantage.
Yeah, I just want to make a comment, Hannah. I think this is fabulous because I think where some people get a little confused is they think they're thinking reverse mortgage, it's a loan. So what he's doing is, as a senior individual that doesn't, maybe go to a job or have a job any longer, they're using monies that they have, equity that they've obtained either in their current home or they've sold their home now. So they've got money coming to them. And instead of spending all the money, he's getting a loan against it and then putting some in savings. Do I have that right?
You absolutely do. And many financial advisors are on board with this because you don't have to deplete your finances. You can still keep money, your portfolio running.
I think also too, with the large expenses of trying to stay in your home as we age, having extra money to be able to fund that, I think is critical. But that's more to come down the road when we have other webinars about that.
Absolutely. That's a great point. Thank you.
Thank you.
So let's switch to a different product. So that reverse mortgage is only for senior citizens, but this bridge loan is another way to get into a home and use equity that you have, and it is not limited to senior citizens. This is for anyone who wants to buy their replacement home before they sell their existing home. So it's a wonderful tool because no one really wants to list their home until they've found their perfect home. You can sell your departing home empty and staged for the highest price while you're sitting happy in your new home. There's no living in a fishbowl while your house is being marketed, or no prepayment penalty on this loan. So when you price your house appropriately and you list with a professional team like the Wong team, then your house will sell quickly for the right price. So you can pay that loan off with having no prepayment penalty. You don't have to move twice, which I did, and it was not fun.
Well, that's because you didn't work with us. That's why you didn't have that much fun.
I know, that's true. There's no cost of renting while looking for a replacement home. That's another advantage. and you don't have to think about living with relatives while you look for a replacement home, which happened to my friend recently. And here's a really big advantage. There is absolutely no cost on this bridge loan until you actually purchase the replacement home. So until they actually fund the loan on your new home, you do not incur any costs. It's very easy qualifying. There's no tax returns. There's no bank statements. It is strictly an equity-based loan. And you can beat out other offers by making a clean offer with a short escrow, because everyone in the business knows that this loan is treated same as cash. I just did one in San Francisco and they closed in 13 days.
Wow.
So the point of these two different loans, the bridge loan for anyone or the reverse mortgage for seniors, is so that you can use these easy qualifying equity-based loans to make your move go smoothly and quickly. Did you have anything to add to that, Debbie or Marla?
Hold on a second. Let me just check. I just got a couple of text messages. Let's see here. Okay, so I have someone that had a question. They're thinking about doing something like this, but I guess their primary concern is the parent is elderly and sickly, and of course, the care for the parent is quite expensive. But what they wanted to find out is, after the parent passes away, how soon would they have to pay off this loan?
That's a great question. So the paperwork, tells you need to pay it off as soon as possible. I think it depends on the lender, and I have all lenders at my access, but some of them say 30 or 60 days. But here's the thing, they give you time, if you're going to sell the home, to market it on the open market. If they see that you've listed it with a reputable realtor and you've priced it appropriate to the market, then they give you extensions and you don't have to pay it off until it sells. Now, if you tried to sell it yourself and it was overpriced, they might start leaning on you to pay it off sooner. Did I answer all of that question?
Oh, that's perfect, actually. Yes. I've got a big smiley face. Okay, I have another question. Okay, on the bridge loan, we have somebody here with two small children. And so they liked your comment about the fishbowl effect, where it would be really uncomfortable having this two small kids trying to keep the house clean, and then, have people coming and going by appointment and all that kind of stuff, just really difficult. They wanted to know, how soon should they set that process up? Should they do it before they find the replacement home?
Yes. So what they should do is have a conversation with me, fill out most of the application, because the only thing that's required is an application. But then I can't approach the source of the money, the investor, until I have two addresses to show him. And since this is an equity-based loan, he wants to look at the two properties online. He'll do a quick walkthrough of their existing home and a drive-by of the new home once we have the addresses. And then I just get a yes or a no. And if he thinks, for example, that you're overpricing your home, that you're going to depart, that you're going to sell, he might lend you a little less. So he's a very, very good investor. I worked for him for 4 years, and we just do these loans very quickly and smoothly. But the answer to your question is, we can get a little bit of the process started, but until we actually have addresses, there's not much we can do. We have to give him addresses so that he can look at the properties, since it's equity based.
Okay, that's fair enough. I have a question. How what about if they got a home equity line of credit on their existing home and then tried to use those monies to purchase the replacement home and then paid off the HELOC when they were done? Is that something that you would
That,
recommend as well?
well, if you're lucky enough to get a big enough HELOC, home equity line of credit, we call it a HELOC, to buy another home, but usually an equity line isn't big enough to do the full purchase on the other home. So it would provide only a down payment, and then you'd have to actually qualify to carry 2 mortgages until your other home sells. It's very tricky. There are some creative products that make it a little bit easier, but generally it's not an easy qualifying process. Now,
I really see
if
the
you,
distinction there. So that's pretty awesome that you have someone
yeah,
that could make that. It's almost like here's all of the money to go buy your new house. I love it. Almost.
yes. And so if you, let's say you got a HELOC against your Palo Alto home that gave you enough money to go buy a house all cash in Texas, then fine, you could do that.
Mm.
But if you list your home on the open market, nobody's going to give you an equity line. So you'd have to get the
Point.
equity line first, and you'd have to be able to net out enough cash to buy the other house free and clear, all cash. It's
Which,
complicated. This bridge
well,
loan
yeah.
works a lot better.
I could really see how that could be a really fabulous product for people to use. And I think how, if you're even thinking about it, that you should really try to educate yourself and get all the facts first and speak with someone like Hannah, who can really plan it out for you to see which thing is going to be better for that person, because everybody's a little bit different or has a little bit different understanding or I guess looking for the word, but anyways, has a little bit different understanding of whether or not they want to go the route of the HELOC or they want to do the route of the investor loan. I like the investor loan.
Yeah, the HELOC is definitely a more complex route to go. Now, if your house is, if you haven't listed it yet, then a lender will give you a HELOC. But if your house is already on the market, you can't even get the HELOC.
Well, I think though, if you are going to think about right sizing, getting a larger home for your growing family, then certainly I think before you do anything, you need to talk to the right people that can give you really great information so that you can make informed decisions.
Absolutely. And the company I work for, Clear to Close Brokers, we are brokers. We have all products available, though I specialize in a few products. My son-in-law, who owns the company, does every type of loan.
Fantastic. Awesome.
And our pricing is better because he owns the company and he doesn't have big overhead.
That's wonderful.
Wonderful. Okay. Well, I don't have any other questions, but I got lots of thumbs up.
Great. Oh, I think we already did this.
A
I think
bridge
we
loan
already
situation.
we already talked about Betsy.
Okay. So, are there any other questions from any of our guests?
I don't have any more text messages. People just usually text. I told them, come on and just go on the chat, and they just text me.
Oh,
but that works too. But no, everybody thought it was great. So
wonderful. Well, it's been a pleasure. And I hope that people keep tuned in because you have so many exciting topics coming up.
Great. Well, let me talk about those really quickly. So we have upcoming seminars. The time and date are TBD. We have
to be advised. Yeah. So I'll go ahead and go through these. I know. Well, we're trying to make it fun and interesting as well. I think a lot of our clients are at the time of their lives where they are going to be named as trustees for their parents or for someone's estate, maybe a friend's estate. So we get a lot of questions. And so Marla came up with this snappy title. So you're a trustee, now what? And I think that's going to be a really popular one. We also get a lot of questions about 1031 exchange and how can you protect the wealth that you build by exchanging. And a friend also mentioned this topic, or the name of the topic, to be swap until you drop. I thought that was pretty fun. It was a very dry subject if you think about it, but I like that one, swap till you drop. And then I believe that in California, it might be a little bit higher because we're a no default divorce state, but I believe in United States, the average statistic for divorce, people divorcing, is about 60%. It's over 60% now. And so there's a very specific nuance to getting divorced and then actually divorcing yourself, not only from each other, but from the house and from the other assets. And so there's a really great seminar that we're going to run on that, about 6 tips or 6 things that you should do if you're thinking about getting divorced. Hopefully you're not, but if you are, and if you own real estate, you want to attend this seminar. And then there's another one about probates. As you know, we are probate certified. So, and we are on a mission to tell every friend, every relative, every client that in order to avoid probate, should one of them pass, get a trust. It's a must. And then stay tuned for date, times, and locations of all of this. Please follow us on Facebook, Wong Real Estate Seminars. And it's been really a lot of fun. And Marley did a great job. Thank you so much. And Hannah, of course, always a pleasure to see you. You look fabulous, and to work with you, and just really appreciate all of your knowledge and how giving you are in answering a lot of people's questions. So thank you so much.
Great.
Thank you both.
So thank you everyone for joining. If you have any other questions or would like more information, please contact Debbie or Hannah. Here's their information below, and we hope to see you at our next seminar. Thank you
All
so
right,
much.
bye for now.
Bye-bye. Thank
See you
you.
again. Take care. Bye-bye.
Bye-bye.